going on, everyone? It's Brian, and welcome back to another segment of the Brian Talks Money Show. Today, we're gonna get right into it. The wait is finally over. Beginning February 1st, the Federal Reserve and the most influential man in the world, Jerome Powell, came out with their latest update on rates, the economy, and their outlook on what to expect next. One of the most crucial things that Jerome Powell mentioned that honestly frightened me was that if you don't smash that subscribe button and give this video a thumbs up, then we're highly likely to expect higher inflation in the months to come. Okay, just kidding. But in all honesty, the purpose of these videos is to help everyone understand how mortgages, money, and real estate work in your favor. So by subscribing and giving this video a thumbs up, it really helps me reach more people that we can impact. And I mean, let's be real, who doesn't want to learn how to make money, save money, and invest money? And real quick, before we get into the fate of the economy and rates, I want to give a big shout out to my sponsors, Mortgage Heroes, and my production partners over at Cruise Productions for always making these videos happen. That being said, let's jump into today's discussion. Okay, so we now know that the Fed decided to raise rates by a 0.25%, something the market was already anticipating and perhaps already knew was coming. For example, mortgage-backed securities began to trend for the better in the second half of the day after the Fed meeting. But although there were somewhat more positive indicators than usual that were moving in the right direction, we can't forget what Kobe Bryant said in 2009 Game 2 of the finals. What's there to be happy about? Job's not finished. And that's exactly what we're here to talk about and break down. What does this mean for your money and monthly expenses? How will this affect mortgage rates, car notes, loans, and credit cards? And what to look out for. So starting right off the bat with today's article from CNBC titled, "Here's what the Federal Reserve's 25 base point interest hike means for your money." The article starts by saying, the Federal Reserve raised the target federal funds rate for the 8th time in a row on Wednesday, in its continued effort to tame persistent inflation. At its latest meeting, the central bank approved a modest 0.25 percentage point increase. After recent signs that inflationary pressures have started to cool, the easing of inflation pressure is evident. But this doesn't mean that the Federal Reserve's job is done, said Greg McBride, a chief financial analyst at Bankrate.com. There is still a long way to go to get to 2% inflation, and if that isn't the mama mentality right there, I don't know what is. Okay, so you're probably wondering, what does this rate hike mean for you? Well, this article goes on to say, what the federal funds rate means to you. The federal fund rate, which is set by the U.S. Central Bank, is the interest rate at which the banks borrow and lend to one another overnight. Although that's not the rate consumers pay, the Fed's moves do affect borrowing and saving rates consumers see every day. This basically means since the bank's rate of borrowing from one another increases, guess who's the lucky winner that gets to pay for those increases? That's right, it's you, the consumer. The article continues to say, this rate hike will correspond with the rise in the prime rate and immediately send financing costs higher for many forms of consumer borrowing, putting more pressure on households already under financial strain. This simply means credit and borrowing are going to get more expensive. Now, we know what this rate hike means for you, but what does this mean for your money? The first thing the article mentions, your credit card rate will rise. Since most credit cards have variable rates, there's a direct connection to the Fed's benchmark. As the federal funds rate rises, the prime rate does as well, and your credit card rate follows suit within 1 or 2 billing cycles. My advice is you're going to want to pay your credit card balances down sooner. Because with this rate hike, you're going to be paying more interest, meaning your payments will be more expensive. Credit card rates are already as high as they've been in decades, said Matt Schultz, chief credit analyst at LendingTree. While the Fed is taking its foot off the gas a bit when it comes to rising rates, credit card APRs almost certainly will continue to climb for at least the next few months. So it's important that your cardholders continue to focus on knocking down their debt. One of the things that really concerned me in this article was that it said credit card annual percentage rates are now near 20%, on average up from 16.3% a year ago, according to Bankrate. At the same time, more cardholders carry debt from month to month while paying sky-high interest charges. That's a bad combination, McBride said. Okay, but can someone please tell me some good news? And what are some options people have available to them? A 0% balance transfer credit card remains one of the best weapons Americans have in battle against credit card debt, Schultz advised. Or using your home equity to consolidate all your debt into one household payment. Although yes, your mortgage payment would go up, you would also be clearing off thousands of dollars of debt while clearing up hundreds of dollars in monthly credit card payments, said Brian Landeros from MortgageHeroes.com. Now, the second thing the article mentions on how this will affect your money is mortgage rates will stay higher. And remember, the Federal Reserve does not set mortgage rates, but rather their outlook and sentiment on monetary policy and economy influences the direction in which mortgage rates will move. The article continues to say rates on a 15-year and a 30-year mortgage are fixed and tied to the Treasury yields and the economy. As economic growth has slowed, these rates have started to come down, but are still at a 10-year high, according to Jacob Chanel, a senior economist at LendingTree. The average interest rate for a 30-year fixed-rate mortgage is now around 6.4%, up almost 3 full percentage points from 3.55% a year ago. Relatively high rates combined with persistently high home prices mean that buying a home is still a challenge for many, Chanel said. We will need to see significant decrease in inflation near our target of 2% until we begin to see a big drop in rates. But from an insider's perspective, although yes, rates are higher right now and it can be an obstacle for buyers, those who are in the position to buy are more likely to snag a better deal at a lower price point because of the decrease in demand. On the flip side, when rates drop again, prepare yourself for bidding wars, overpriced homes, and even more minimal inventory. And that's something you want to keep in mind if you are having doubts of buying in 2023. Now, the third thing mentioned in the article, auto loans will get more expensive. The article reads, even though auto loans are fixed, payments are getting bigger because the price for all cars is rising along with the interest rates on new loans. So if you're planning to buy a car, you'll shell out more in the months ahead. The average interest rate on a 5-year new car loan is currently 6.18%, up from 3.96% last year. The Fed's latest move could push up the average interest rate even higher. Although consumers with higher credit scores may be able to secure better loan terms or look to some used car models for better deals. Bottom line, anything attached to personal credit and finance will be getting more expensive in the months to come. So you can expect the same to happen to your student loans and personal loans that you plan on getting. So keep that in mind when applying for new credit loans in 2023. Now, to wrap all this up, the Fed's decision to raise rates by 0.25% was still an effort to bring inflation down to their target rate of 2%. Yes, Jerome Powell did mention that we are starting the deflationary process, but only in certain economic sectors, and nothing secure within proximity to their economic goals, meaning we can expect future rate increases as we progress into 2023. My personal advice is that now, more than ever, understand how money works. Financial literacy has never been more important than today. And that's the purpose of why I do these videos, to help people gain financial literacy in understanding how money, mortgages, and real estate work for you. So do me a favor, if you found this video insightful or helpful in any ways, please share it with a friend, coworker, or family member. And don't forget to subscribe and like this video so we can continue to reach new people and get this information out to them. So with that being said, thank you for watching and I will see you on the next one, and don't forget to subscribe.